Alright guys, welcome to multidimensionaltrading.com. This is our 10-part video series. This is video number 7. Today we are going to get into how to catch the liquidity grab and know exactly where to get in near the lows, below the lows, so you get the best possible entry. Okay, it's less stress and it's a better way to enter the market than most things that are out there that you might see out there. It's one of the best entries you can get. It really doesn't get any better than catching the bottoms and the tops of the marketplace, right? So let's get into it. As you can see here, guys, we have the equal lows, right? Equal lows. And right below the lows are where most traders, including myself, will place stop losses. Okay, now what are stop losses? Stop losses are basically when you're going long. Stop losses are willing market sellers. That means if the price ran against us, we are willing to sell our positions right then and there. We do not want to be in them anymore. We want to sell and get out of our positions because we are going long. That's what stop losses are. They're basically sell orders. We were buyers here and now prices ran down. We're getting stopped out. We're all selling together. Willing sell orders. That's what our stop losses are. So when we all together, there's a collective marketplace gets together and we all set a stop loss below our entry price, we are technically setting the market price. It is as simple as that. It's like this. If everybody in one neighborhood says houses are $200,000, then if you go to that neighborhood, houses are $200,000. No one's selling them for more or less than $200,000. So the price of homes in that area will be $200,000. It's no different than you're looking at any asset on these charts, whether it's Bitcoin or Eurodollar or DXY or gold or silver or any other asset out there. If everyone sets their orders in a specific area, that is what the price chart is going to represent. It's going to go to that area at that price. So if everyone sets their orders in that certain area, once again, the price is basically being set. That is the market price. That's what everyone will see on their screen eventually when everyone sets the orders there. So equal lows normally, right, get broken because it comes to a point where everyone goes in heavy right here. Everyone wants to catch the pump, catch the bounce, and then they all put their stop losses right below the lows, trying to play it safe, which is a good way to do it, and it makes sense. However, you're basically a target when it comes to the short sellers, right? Short sellers are running it down. They cover here, people buy here, and then it also runs down into those stops. And then there's some short sellers that are just gonna wait until it runs right below the lows into that liquidity area, because that's literally what it is. Liquidity is just a term that we use to describe where everyone in the marketplace is willing to change hands on a price. Everyone will change hands on that asset at that area, that set given price. That's all liquidity is. So if the short sellers are willing to basically buy their orders back here, and the stop loss, the people who went real heavy right here are also willing to sell all of their positions down here, that's where the price is going. Take profits are here for the short sellers, stop losses are here for the longs. That's where the market price is. Now, what we do with this information at multidimensionaltrading.com, we understand that this is where we can take our positions to go long. After everyone is out of their positions in the marketplace, it's most likely time to change directions and go the other way. It went down. Shorts are enjoying the run. People are trying to catch the dip and go long here. They place stop losses below the lows. So price comes down, takes that out. Everyone exchanges hands in this area. Short sellers buy their orders back. Stop losses are basically sell orders, selling it to the stop of the buyers, right? Selling it to the buy orders, and that's pretty much how the market works. And then this is where we look at the market and say, okay, we know what everyone's doing. We know what the majority of the market is doing. We are taking and looking for an area to go long. We're looking for it to behave a certain way to show us, okay, this is it. It's time to go long. And as you can see, it bounced real nice and hard here, comes back down, and then this is where we enter, right? The pullback area. And then it never comes back. Never comes back. TP1 is what we would take our take profit at, or at least the first take profit at, after this long run down. Because remember, we're not shorting at break evens after we've had a long, extensive run to the downside. Break evens at this point would be our take profit. Now, we could short it, sure. As you can see, it ran down on, this is the 15-minute time frame, so it ran down for a nice little period of time, right? That's 15, it was an hour, about 2.5 hours. It did run to the south side, to the downside. However, this is not where we would short it. It would make more sense for us to take profit here and then wait for the next take profit and then the next take profit, which are going to be square at break evens, basically where people got screwed at, right? That's where we are running back into that area. They want the price to come back to this area more than we want the price to come back to this area. So we know we have high probability trades of liquidity being here and here and here rather than anywhere else. It's all about what the chart has done historically to understand where it's going to go in the future, right? And the things on these charts happen over and over. This is nothing new. This happens over and over. Any experienced trader will look at this video and say, okay, yeah, this guy knows what he's talking about. This is what happens. They might use different names or different terminology, but you can look at it and say, okay, yeah, this is what happens. This is literally how they would set up a chart, because it's just how it works. This is just how the market works. Anyone who's looked at the chart and practiced and did a lot of watch time, you're gonna see the same thing happen over and over, and you're gonna realize, like, okay, well, this is how I can take advantage of it. Equal lows, and you could buy here. There's nothing wrong with buying at the equals. I do that all the time. I buy at equals, like I run up, I'll take a run up, and I'll usually will most likely get out, just because I understand that if it does get really hot and heavy and everyone sees that it's about to go up, it usually gets longed here. And if everyone longs it here, they're going to put their stop losses here. So the market price runs right back down, because that's where everyone's setting the price at. And then on top of that, we have, in conjunction with the shorts, having their take profits here, setting their TPs here, and stop losses are also here. So market price has to run down into this area. Everyone in the market is agreeing that the price is here. TPs have set the price here. Stop losses has set the price here. It is simple as that. That is why price on the price chart represents where the market is setting the price. Now, once you see that violent exchange here, that violent up, that violent down, we know we have done the job. We know something has happened. The market has shown us its hand. It is as simple as that. This is where we go long. Break evens is where we'll take our profit. Okay, we get in at the equal lows or below the equal lows. We take our profit at break evens on this run up. This is break evens. And I know I've explained break evens before, but it's simple as this. These people in this area tried to buy the dip. That didn't happen for them. They got flushed out, straight all the way down. Okay, big sad. They've waited a long period of time to finally get back to break even if they're holding that position. So this is where we'll take profit just in case it wants to fall pretty hard. And it always falls when it gets back to these people because they're going to close their positions as well. This is where our take profits meet them closing their position. So that's another spot where liquidity will be found. So that's where we get out of our position, or at least take profit on part of our position. Okay. Next area is going to be this break even area. And it's break evens for these people, right? They bought at the lows here. They bought at the lows here. Flushed down. Came back up. People are buying here, hoping they caught the dip. That didn't happen for them. They got flushed on out. Comes back to them. We know this is another area where it's going to be liquid. This is where we can relinquish some of our positions and sell some of our position. It's simple as that. We know this is also an area it would most likely take a reversal, right? It might not last forever, but it might take a reversal there because there's going to be sell pressure here. It's as simple as that. We know these people got screwed. We are reading the chart in an area, in a likeness where we know that what people are thinking and what they're feeling because we've been there and we are literally experiencing the same things all at the same time. So if we understand how these people feel, we know how to set up our trades. That's how we can use this chart analysis to our advantage. It's as simple as that. Then we have these set of people right here. They bought here, bought in the lows. What happened to them? They got flushed out. They did not catch the long to the upside. Sucks for them. However, we know that when the price gets back to them, they're going to be at break even. So that's where we take profit again. That's where we know there's a liquid area for us to take profit or to sell our orders into. There's going to be a nice rush into that area because that's where the price is going to be set at. They're setting their break evens here. We're setting our take profits here. Break evens meet take profit. That's where everyone will exchange hands. That's where liquidity is. It's as simple as that. That's where we know price will go to. So we're using the methods of understanding where everyone will set the price to find out how much of a trade we have, right? And it allows us to hold trades for longer as well, too. Because we understand where price is heading to, or where price is most likely to head to, right? This is not a crystal ball. We're not fortune tellers, but we can see with high probability where the people have been and where price is most likely to go. And that is how we do it. It's really simple. This happens on every chart, on every asset, over and over. There's always the equal lows, and I usually always long the equal lows because I know without a doubt I can catch the bounce on equal lows. Like if you look at this equal points of contact on this horizontal line, 15, 30, 45 minutes to the upside that's 45 bars on a 1 minute. Okay, that is a nice chunk of change right there. You bought at the lows at 109.0555, all the way up to 200 and something. That's already over 200 pips. okay? Or I'm sorry, 200 points, right? Which is about 20 pips, but 200 points is on one lot, that's $200, okay? There's nothing wrong with catching something that you know that happens over and over. And then you also can catch the long after liquidity has been taken out. There's nothing wrong with playing both aspects of this market as long as you understand where you stand in the market and where it is and what you're looking at. And it's simple. Equal lows, they'll take a bounce. It does, I don't want to say trick people, but it does make everyone believe, hey, this is support area, so we all can go long. And then what happens? Everyone does go long, but they all set their stops in the same area. So price is going to run down to those areas where everyone set price. People who are short are also understanding this. If they're savvy traders and they're smart traders, there's a lot of good information out there in the world now where people understand where to find liquidity at. And they understand that they can find liquidity resting right below the lows where people's stop losses are. They're willing to sell their positions to the people who are willing to buy the positions. It's as simple as that, and that's where everyone changes hands, and then the market changes direction because liquidity is not here anymore. It's gone. Everyone's out. Sellers have sold, which were stop losses. Buyers have bought, which were people taking short positions, closing their position. Now, only thing left is to go up to where the next liquidity pool is, which is the break evens and the take profits, right? I'm taking profit here. These people are hoping and praying that the price comes back to them so they can get out at zero. Liquidity was here. It's been taken out. Now liquidity is here. Okay, once we take that out, okay, people go along. These people are still hoping to get their money back. Liquidity is here now. The next level. It gets taken out. It falls. People go along. These people are hoping to get their money back. It goes up to the next level. So we can literally see where it's at, how the chart behaves, and why it behaves this way. Because it's going to be a market. There's always two sides to the coin. And the price always reverses where these two different sides meet. You have your bullish and your bearish side. And when they meet, that's where it gets violent, right? So all you guys have to do is pay attention to that and you'll understand what you're looking at. Practice that. Demo, check the charts on any asset, every asset. I know I've said a lot here. Watch it twice, watch it 3 times. Practice it on other charts, on other assets, and you'll see that this happens over and over. So thank you guys for watching. This is multidimensionaltrading.com. Like, subscribe, follow us on Twitter, follow us on Instagram. We will see you guys in video number 8. Lesson number 8 coming soon. So, guys, enjoy your day, enjoy your weekend, enjoy your holidays. Peace.